It's already happening. Brent didn't cross $110 because traders panicked. Brent didn't cross 110.0 because OPEC announced new cuts. Brent didn't cross $110 because the dollar moved on a Fed comment. And Brent isn't sitting where it is today because of speculation. It's sitting there because the largest oil supply shock in recorded history is unfolding in real time, and almost nobody on financial television is connecting the dots correctly. JPMorgan's Natasha Canova and her global commodities team have been publishing the math for 6 weeks now. The world holds 8.4 billion barrels of oil in storage. Of that, only 800 million barrels are actually accessible. The rest is locked in pipelines, tank minimums, refinery operations, and strategic reserves that cannot be touched without breaking the system. As of late April, 280 million of those accessible barrels have already been consumed. The remaining buffer is roughly 520 million barrels, and it's draining at 2.2 million barrels per day from OECD commercial storage alone, on top of a 2.7 million barrel per day draw from oil on water inventories that began the year at 1.8 billion barrels, and have already lost 140 million. That's not analysis from a YouTube doom channel. That's verbatim from JPMorgan's April 30th client note, the same desk publishing Bloomberg syndicated research read by every institutional commodity trader in the world, and their conclusion is the part the financial press is downplaying. OECD commercial inventories hit operational minimums between May 9 and May 30th. That's days from now, not months. Past that threshold, in JPMorgan's exact language, price increases become exponential rather than linear. Read that phrase again. Exponential rather than linear. Welcome back to the macro mirror. In this breakdown, I'm going to walk you through exactly what JPMorgan's operational minimum analysis means with the actual numbers from their April research notes. I'm going to explain why physical oil prices in Singapore have already hit $200 per barrel, and Sri Lanka has touched $286, while futures benchmarks still show $110, and why that gap matters more than any headline price. I'm going to give you the historical analog from the 1970s oil crises that mainstream media keeps getting wrong. And I'm going to give you the 4 signals that will tell you whether the September recession scenario is being priced in or whether the system finds an exit before then. Quick favor before we go further. Subscribe. If you want clean breakdowns of macro chaos when it actually matters, not hype, not cheerleading, just the mechanics, hit the bell. Operational floors don't announce themselves through press releases. They announce themselves through diesel shortages and refinery slowdowns. Let's get into it. Let me start with the numbers, because this is the rare moment where the underlying data is more dramatic than any analyst's commentary on it. The disruption from the closure of the Strait of Hormuz is, per the International Energy Agency, the largest oil supply shock on record. JPMorgan estimates the effective loss at approximately 14 million barrels per day. Pre-war, 7 key Persian Gulf producers were supplying roughly 32.7 million barrels per day across crude, condensate, and natural gas liquids. Today, JPMorgan calculates shut-ins at approximately 12.3 million barrels per day, with another 1 million barrels per day at risk. The Strait of Hormuz handles roughly 20% of global oil flows. It is currently functioning at near zero capacity for outbound exports. The world has only 2 release valves when production falls 14% below demand: inventory draws or demand destruction. JPMorgan tracks both. OECD commercial crude inventories drew at 2.2 million barrels per day in April, accelerating from a modest 450,000 barrel per day draw in March. In absolute terms, OECD commercial stocks fell from 2.8 billion barrels in February to roughly 2.72 billion barrels today. While oil on water inventories drew at 2.7 million barrels per day. The last cargo from Hormuz arrived on April 20th, meaning the headline draw rate is about to moderate, but only because there are no more outgoing shipments to draw against. On the demand side, JPMorgan estimates global oil consumption fell by 2.8 million barrels per day in March and is tracking a 4.3 million barrel per day decline through April. May is projected to bring further demand destruction, reaching 5.5 million barrels per day. To put that in context, the peak demand destruction during the 2008 global financial crisis was approximately 2.5 million barrels per day. We are now seeing demand destruction at twice that level in a fraction of the time, while oil prices remain technically below 2008 nominal highs. That last fact deserves attention. Brent peaked at $118.35 during this crisis. WTI peaked at $112.195. Both still sit roughly $20 below their 2008 records. The question every serious analyst is asking is, how is the largest supply disruption in recorded history producing prices below 2008 highs? The answer is not that the market is calm. The answer is that futures prices no longer reflect the real cost of buying oil in a scarce market. Physical prices for near-term delivery in Asian markets are running far above the headline futures benchmarks. Singapore physical crude has reached $210 per barrel. Sri Lanka has touched $286. These are real transactions for real cargoes, not theoretical strikes on derivatives. The futures physical spread is the cleanest signal there is that the visible price is no longer the operational price. So here's the first lesson. When a major Wall Street commodities desk publishes a specific date range, May 9th to May 30th, for OECD inventories hitting operational minimums with the explicit language that pricing becomes exponential rather than linear, past that point, they are not making a prediction. They are warning institutional clients to prepare for tail risks that are no longer theoretical. The futures market is showing a controlled decline. The physical market is showing what happens when the controls fail. Let me get more concrete about why an operational minimum actually matters. Because the term sounds technical, but the concept is mechanical. Picture a senior refining operations manager at a major facility on the U.S. Gulf Coast. Tuesday morning, May 5th, 2026. He receives the weekly inventory report. His facility has 18 days of forward refining cover at current throughput, already below the 30-day cushion he typically maintains. The crude grade he runs comes from a mix of domestic shale and seaborne imports. Two of his Asian counterparties have postponed shipments because their cargoes were redirected to higher bidding refineries in Singapore. His scheduling team is trying to source replacement barrels from Cushing, but the Cushing inventory is being drawn down at 1.8 million barrels per week, and merchants are quoting prices that would compress his refining margin to negative. He has three options. He can pay the merchant prices and run at a loss to maintain throughput. He can reduce throughput by 15-20%, which means less gasoline and diesel reaching local distribution, or he can run at full throughput. While his crude inventory drops below the 14-day operational minimum, his engineering team has flagged as the safety floor for stable operation. The first option destroys quarterly earnings. The second option creates regional fuel shortages. The third option risks an unplanned shutdown that takes weeks to recover from. He calls his counterpart at a refinery in Texas. Same situation. He calls his counterpart in the Midwest. Same situation. By Tuesday afternoon, his operations team has decided to cut throughput by 12% starting next week. The local distribution network won't notice immediately. There's enough product in the pipeline to mask the change for about 10 days. By the end of May, gas stations across his service region will start reporting outages. By mid-June, the diesel crack spread, which has already hit a 52-week high for 8 consecutive sessions, will widen further. By July, trucking companies that depend on diesel availability will be making the same difficult choices he made today. That's the conversation that's happening at every major refining operation in the OECD this week. Not in press releases, in quiet throughput reductions and inventory rationing, with cumulative effects that don't show up in headline oil prices for weeks, but show up in physical fuel availability much sooner. So here's the second lesson. The September recession scenario is not a forecast about what oil prices will do. It's a forecast about what the operational system itself does when one of its physical floors gets breached. Once a refinery throttles back, the lost throughput doesn't get made up. Once a distribution network loses capacity, the shortage propagates through every downstream user. Once stagflationary pressure builds in the real economy, the central banks that would normally cut rates to support growth find themselves trapped between persistent energy inflation and policy paralysis. Let me put the historical pattern under a microscope, because the 1970s analog is real, specific, and almost universally misunderstood. In October 1973, the Yom Kippur War triggered the OPEC oil embargo. Arab oil producers cut exports to Western nations, supporting Israel. The supply disruption was approximately 4 million barrels per day at peak, a fraction of today's 14 MBD loss. Yet within 5 months, oil prices had quadrupled from $3 per barrel to $12 per barrel. The U.S. economy entered recession in November 1973. Inflation hit 11% in 1974. The Fed, under Arthur Burns, hesitated to raise rates aggressively because of political pressure and economic damage. Stagflation became the defining macroeconomic condition of the decade. The 1979 Iranian Revolution produced an even smaller absolute supply disruption, about 2 million barrels per day, but oil prices doubled from $14 to $35 within 12 months. The Federal Reserve under Paul Volcker eventually broke the inflation by raising rates to 20%, but only after the economy had absorbed years of compounding damage. The recession that followed was the deepest since the Great Depression. Volcker succeeded because the underlying U.S. debt burden was small enough to absorb 20% rates. That option is not available today at $39 trillion of debt. The pattern is specific. A supply shock that begins as a geopolitical event becomes an inflation event. The inflation event becomes a monetary policy crisis. The monetary policy crisis becomes a recession. The recession compresses demand, eventually rebalancing the market. but at a level of economic damage that takes years to recover from. The 1973 episode is the closest historical analog to the current setup, scaled by today's oil intensity of the global economy, and the fact that today's disruption is roughly 3.5 times larger in absolute terms. JPMorgan's September recession framing is not hyperbole. It's the application of the 1973-1974 sequence to the current data. Supply shock in late February, inventory draw through Q2, operational minimum breach in May or June, price exponential phase through summer. Demand destruction reaches recessionary levels by Q3. The exact sequence the 1970s ran, on a faster timeline because the underlying disruption is larger. Is that proof a September recession is inevitable? No. The 1970s recession started in November 1973, roughly 13 months after the embargo began. Today's analog timeline would put the recession trigger in late Q3 or Q4 of 2026, which is exactly what JPMorgan is modeling. What's not proven is whether the Strait of Hormuz reopens in time to break the sequence and how quickly the physical system can recover, even if it does. JPMorgan's own analysis says full recovery to 99% of pre-war capacity takes approximately 4 months after a reopening, with rebuild of safe inventory cover taking another 4 months on top of that. Even a best-case reopening tomorrow doesn't avoid the operational minimum breach that's already in motion. Let me give you the bear case fairly, because this thesis is consequential enough that the counter-arguments deserve real treatment. The bear case, meaning the scenario where the September recession does not materialize, rests on 3 possibilities. 1, the Strait of Hormuz reopens within the next 2 to 3 weeks, allowing immediate cargo flows to relieve the inventory pressure. 2, a significant ceasefire or framework agreement compresses risk premia, allowing demand to recover and inventories to stabilize at current levels rather than draining further. 3, emergency coordinated SPR releases, building on the 400 million barrel IEEA coordinated release in March, buy enough time for physical supply to rebuild. These are real possibilities. The IEEA has demonstrated capacity for coordinated action, diplomatic backchannels remain active, and the JPMorgan analysis itself acknowledges that under a quick reopening scenario, OECD inventories could approach but not breach operational stress before relief arrives. Goldman Sachs has assumed exactly this scenario in their fourth quarter Brent target of $90, meaningfully below JPMorgan's stress case targets. Citi sits between the two camps with a $150 Brent target if the disruption persists through June. What unifies all 3 bear case scenarios is that they require something concrete to happen: a reopening, an agreement, a coordinated release within a specific window. None of them describe a situation where the current trajectory simply resolves on its own. That's the asymmetry of the current setup. The base case requires action. The stress case requires only continuation. So ask yourself, when JPMorgan is publishing operational minimum dates between May 9 and May 30th, when physical oil prices in Asia are already running at $210 to $286 per barrel, when demand destruction has hit twice the 2008 peak in a fraction of the time, when the Strait of Hormuz remains effectively closed for outbound exports, and when the historical analog from 1973-1974 played out almost exactly this way at a smaller scale. What does the current $110 Brent price actually represent? A market that has already absorbed the shock, or a futures benchmark that's structurally lagging the physical reality the global economy is paying for? Now let's read the current action like a forensic report. The forensic case is built on signals that are converging in the same direction. The diesel crack spread has hit a 52-week high for 8 consecutive trading sessions, the leading indicator of physical refining stress. The futures physical spread between Brent and Asian delivered prices is the widest on record, with Singapore at $210 versus benchmark $110. OECD commercial inventories are drawing at 2.2 million barrels per day, accelerating from 450,000 barrels per day in March. The oil on water inventory has lost 140 million barrels in 2 months. Spirit Airlines shut down at the start of May. JPMorgan's analysis flags this as the first of many in airlines, transportation, manufacturing, and energy-intensive industries. You would also expect the bullish institutional voices to be moderating their views as prices remain below the 2008 nominal high. They are doing the opposite. Citi raised its targets. Goldman raised its targets. JPMorgan's stress case has remained at $200 to $300. The persistence of high institutional targets despite contained futures prices is itself a signal. The analysts who track the physical system are seeing what the futures market is missing. So here's the cliffhanger. The May 9 to May 30th window for OECD operational minimums opens within days. Physical prices are already pricing the breach. Demand destruction is at twice the 2008 peak. The strait remains closed, and the financial press is still describing this as a contained geopolitical event rather than a structural breach with September recession implications. The convergence between paper and physical, when it happens, will not happen smoothly. Let me put the macro context around it, because oil doesn't trade in isolation. Gold is at approximately $4,238. Central bank gold buying continues at structural levels. Silver is at $73, down 40% from its January peak, with COMEX coverage at 13.4%. The Federal Reserve is in transition. Powell's term ends May 15th. Kevin Warsh's confirmation path opened on April 24th. The May FOMC is days away with zero probability of a rate cut according to CME data. The fiscal deficit is $1.9 trillion. National debt has crossed $39 trillion. The Trump administration is openly demanding rate cuts the data doesn't support. Every one of these factors compounds the oil shock rather than offsetting it. Higher oil prices feed inflation. Persistent inflation prevents rate cuts. Frozen monetary policy traps capital between rising prices and unattractive real yields. The same setup that produced the 1970s stagflation is reassembling, with the additional constraint that today's debt burden makes a Volcker-style response mathematically impossible. The structural conditions for a disorderly resolution are more developed than they were at the equivalent point in 1973. Here are the four signals that matter more than any headline you'll read this week. 1. EIA weekly inventory updates released each Wednesday. If U.S. commercial crude stocks draw above 5 million barrels per week for 3 consecutive weeks, the operational minimum timeline accelerates from late May toward mid-May. If draws moderate below 2 million per week, the bear case scenarios are activating. The data is publicly available and updated reliably. 2. The diesel crack spread, currently at a 52-week high for 8 consecutive sessions. Watch for a break above $50 per barrel, historically the threshold that precedes physical fuel shortages by 2 to 3 weeks. A sustained spread at current or higher levels confirms the refining stress is reasserting in real time. A sharp narrowing would signal the physical pressure is easing. 3. Strait of Hormuz tanker traffic, currently near zero for outbound exports. Any meaningful resumption of transit volumes, even partial, signals de-escalation. Continued blockade at current levels signals the worst-case timeline is firming. Marine traffic data is publicly tracked and updated daily. 4. Federal Reserve commentary on rate path. Watch the May 30 FOMC statement and Chair Powell's final press conference. If Fed officials explicitly acknowledge that 2026 rate cuts may be off the table due to energy inflation, that's the signal that the stagflation scenario is being priced into policy. The language matters more than the rate decision itself. Now, I'm going to ask you 2 questions, and I want your honest answer in the comments. First, pick a price for Brent crude at end of Q3 2026 and commit to a specific number. $90 like Goldman's base case, $150 like Citi's stress case, $200 like JPMorgan's lower stress range, $300 like JPMorgan's upper bound? Or do you think the strait reopens and Brent retraces to $75? Drop your number, drop the catalyst you think drives it. Don't hedge. Second, of the 4 signals, EIA inventory data, diesel crack spread, Hormuz traffic, or Fed commentary, which one would most clearly mark the inflection point if September recession becomes the base case rather than the stress case? The answer determines what you should actually be watching over the next 60 days. Now, what should you expect next? Expect volatility. The May 9 and into May 30th. Window opens with physical prices already breaking from futures benchmarks. The path through summer will not be linear. There will be tactical reversals, ceasefire headlines, coordinated SPR release announcements that buy days or weeks of relief. None of them change the underlying mathematics of the inventory drawdown. Expect mainstream financial media to continue describing the situation as a manageable geopolitical event. The narrative does not lead the price. The narrative follows the physical system. By the time the financial press acknowledges that a stagflationary recession is the base case, the move will be visible only in retrospect. And expect the recession trigger, when it arrives, to be uncomfortable for everyone, including positioned holders. Stagflationary recessions are historically the worst environment for traditional financial assets. They are also historically the single best environment for monetary metals, which is why gold and silver positioning matters at this exact macro moment. The investors who position before the consensus shifts capture the moves. The investors who wait for confirmation arrive after the easy entry points are gone. I'm not telling you what to buy. This is education, not personal financial advice. Your situation is your situation. But I'm telling you what the structural setup actually is, with real numbers from JPMorgan's research notes this week. OECD commercial inventories hit operational minimums between May 9 and May 30th. Past that threshold, JPMorgan explicitly says pricing becomes exponential rather than linear. Physical prices are already at $210 in Singapore and $286 in Sri Lanka, while futures show $100. Demand destruction is at 4.3 million barrels per day, twice the 2008 peak. The 1973-1974 historical analog ran exactly this sequence at a smaller scale. Amateurs watch the futures price. Pros watch operational floors, crack spreads, physical premiums, and the gap between paper and physical. The amateur tape says oil is contained. The professional tape says the largest supply shock in recorded history is approaching the threshold where the system itself becomes the constraint, not the price. Oil has been the central commodity of the modern economy for 100 years. It has priced every major geopolitical disruption in that period: the 1956 Suez Crisis, the 1973 embargo, the 1979 revolution, the 1990 Gulf War, the 2003 Iraq invasion. Each one rewrote the macroeconomic regime that followed. The current disruption is larger in absolute terms than any of those events. The structural setup it produces is not subtle. So here's the clean summary. Brent is at 110. JPMorgan models OECD commercial inventories, hitting operational minimums between May 9 and May 30. Past that threshold, pricing becomes exponential rather than linear. Physical Asian prices are already at $210 to $286. Demand destruction is at 4.3 million barrels per day, twice the 2008 peak. Supply disruption is 14 MBPD, the largest in recorded history per the IEA. JPMorgan stress case targets $200 to $300 Brent under sustained Hormuz closure. Citi targets $150 if disruption persists through June. The 1973-1974 historical analog ran this exact sequence at a smaller scale, and the financial press is still calling it a manageable geopolitical event. This is where the serious holders of monetary assets separate from the tourists. The tourists watch CNBC. The serious holders watch the inventory math. If you want the next breakdown, the moment OECD inventories breach operational minimum, the moment the diesel crack spread breaks $50, the moment the Fed acknowledges the stagflation scenario, subscribe. These shifts don't announce themselves on the channels that are paid to keep you looking the other way. Hit the bell so you catch the move before the headlines do. Drop your Q3 Brent target in the comments. Tell me which signal you'd watch most closely, and I'll see you in the next one.